Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
Today, we will unravel the failure of Investmint, a promising Indian fintech startup that shut down in February 2024 despite raising funding, gaining traction, and having a growing user base. If you are in your 20s and dabble in finance or are curious about algorithm-based investing, chances are that you might have heard of Investmint. It was sleek, data-driven, and promised a smarter way to trade in the Indian stock market. So, what went wrong? Let's break it down into two parts, the rise and fall highlighting the challenges, followed by key takeaways for founders. Part 1. The rise. Founded in February 2022 by Akash Goel and Mohit Chitlangia, Investmint aimed to help retail investors make informed investment decisions and manage wealth with data-driven insights. At its core, the platform used algorithms to generate quantitative trading strategies, called stacks, that aimed at outperforming the market without the users needing deep financial knowledge. It was the perfect pitch for the digital-savvy, young Indian audience looking to move beyond tips and guesswork. The founding team was experienced. Investmint had raised $2 million in seed funding from Nexus Venture Partners to build its tech platform. For a while, things were working. Users were adopting the app, the feedback was strong, and there was clear market validation for their product. But just like in investing, traction alone doesn't guarantee success. Part 2. The downfall. Despite its initial promise, the startup ceased operations after failing to establish a sustainable business model. Investmint ran into three key challenges, and they were: A. Revenue model versus unit economics. Unlike brokerage-based platforms like Zerodha or Grow, who make money per trade or on AUM, assets under management, Investmint was predominantly a freemium product. Many users used the app without paying a dime, and thus the funding had to carry the weight of customer support, tech infrastructure, and ongoing R&D. While their paid subscriber base was growing, it wasn't growing fast enough to cover the ever-growing burn. In short, their LTV, lifetime value, per paying customer wasn't enough to cover their CAC, customer acquisition cost, ultimately leading to an unsustainable business model. B. Regulatory uncertainty in fintech. Although fintech in India is a hot sector, but it's also a highly regulated one. Investmint operated in a tricky space where algorithmic investment advice can be perceived as crossing over into financial advisory, which demands CB registration and compliance. Investmint's app worked around it using disclaimers claiming to only provide information, not advice. But the gray area became increasingly difficult to navigate, and regulators' evolving stance on investor protection, suddenly Investmint's survival felt like a ticking time bomb. C. Funding, winter, and pivot pressure. In 2023 to 24, the funding winter hit Indian startups hard. Valuations shrank, and VCs pulled back, expecting to have profitability and clear compliance models as the new norm. Investmint couldn't raise Series A, neither did they have the runway to pivot or buy more time. They had to choose to pivot aggressively or shut down gracefully, and they chose the latter. In a LinkedIn post, Goel stated, "As of today, we've successfully concluded the process and returned over 25% of investor capital. While we couldn't get to any meaningful stage, Chitlangia and I are incredibly thankful for the support from our investors, users, and all 30-plus phenomenal teammates who gave it their all behind the mission." While the startup has shut down, it is also exploring acquisition opportunities with well-capitalized wealth management companies. Finally, key lessons for the founders. So, what can you learn from the shutdown of Investmint? Here are the 5 takeaways. 1. A cool product doesn't equate to a sustainable business. Investmint's product was genuinely innovative and useful, but the economics weren't. Before scaling, make sure your business model actually supports growth. Don't build a castle on sand, no matter how beautiful the architecture. 2. Monetize early, validate real demand. Too many startups delay monetization to chase user growth. But you need to test users' willingness to pay early. Freemium is seductive but dangerous if conversion rates stay low. Investmint had users, but not enough paying ones to generate profitable revenue. 3. Raise for growth, not for vanity. It's easy to raise money when times are good, but the best founders prepare for when they're not. Investmint couldn't raise enough to outlast the funding winter or pivot. Always keep a 12 to 18 months runway and never overspend on vanity metrics. 4. Adhere to the regulations, even if in the gray areas. If your startup operates in a regulated space, don't just find legal loopholes. Engage proactively with regulators. Build compliance into your product roadmap from day one. When in doubt, seek clarity, not ambiguity. 5. Shut down gracefully if nothing works. If things aren't working, own the decision to shut down. Don't drag your team, investors, or users through uncertainty. That way, Investmint shutdown was mature and respectful. They ended their journey with dignity by returning back 25% of the investments, and that's something rare and more founders need to normalize. Investmint showed great promise, a product with real utility, and a vision that matched the market, but in the end had to shut down. It's a proof that great ideas still need great execution, timing, regulation alignment, and sustainable economics. After all, failure isn't final, but it's always a great teacher. Do you think startups should do away with freemium models? Let us know by commenting on the podcast. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.